Hey everybody, it's Shannon from alphatrends.net. Today is Friday, the 23rd of August, 2019. The market got hit pretty hard here today, and that brought us negative for the week. We had gapped up on Monday and things were holding, but obviously today we had a series of tweets that shook the confidence of investors and resulting in a sell-off. We're now below the 50-day moving average, and that 50-day moving average, which is the green one up here, is going to start turning lower once again. On Monday, we start to get rid of this data. We average that out, in other words, because that was 51 days ago. We'll get rid of that, and that means as we replace data up here in this area with data that's still lower, that 50-day moving average will start to turn lower, and that's a clear reason to become a lot more cautious. You saw that it happened over in here back in late October, and it's not a sell signal, but it is definitely saying it's something we need to be prepared for, a little bit more defensive, that is. Now today's action brought us down towards the low end of this range. Let's take a look at the 30-minute time frame. You can see that this has been kind of the band of resistance up in here and the recent band of support. It seemed as though we were trying to hold on up there, but couldn't have any confidence with the ugly picture of the daily time frame, and knowing that all of this macro news is out there, just waiting for a tweet to wreck the entire party, which is what happened. So for next week, I think it's highly likely that we continue lower and at least test this 200-day moving average at 280. More likely, we would come down to the volume-weighted average price from the December low. That's at about 279. And there's nothing saying that that will solve this and that we'll be done going down. So maybe we come down like this and rally back up a little bit, find resistance at the prior support, and then I think the more likely area that we might start to rebuild some energy is down here at about this 273 level. Now 273 has been important as far as a bounce area in March, and then a bounce area once again in June. But we can also look at this and say it's the measured move objective. So in other words, if we take the height of this, which is 302, down to the low here, let me just draw that in so you can see what I'm doing. If we take this 302 is the height, down to this sell-off low, about 282 or 20 points, and then we go up to point B, 293, let's call it, and subtract 20 points from that, we get 273. So the measured move looks like it's likely to head down towards 273. Now, if it broke that, I think it would again be a trap. What we want to do is learn to be anticipatory, not short the lower low necessarily, because by then the move is already most likely obvious and you can't be late. You have to be anticipatory. As my friend Todd Gordon reminded me, there was a quote attributed to Linda Raschke, which is that markets go to the obvious level, but in the least obvious way. So I think we're going to see this volume-weighted average price tested. I thought we were going to do it after this bounce in here, but it's the least obvious way. Anyone can call where the market will be at the end of the year, but does it actually mean anything? By the way, in October, I will be at the Money Show in Dallas giving a talk about the volume-weighted average price. So if you have questions about how this works and you're in Dallas, I'd love to see you there. The Nasdaq, similar situation, of course. We've got this band of resistance overhead. We've got that 50-day moving average, which is going to start to decline, and we're stuck with a declining 20-day moving average. Even the declining 20-day moving average gives us certain indications of when we want to be more cautious. And this has been declining now for the last, since the beginning of the month, basically. And it looks highly likely that we at least come down to the 176, 170, well, basically 177 level next week. And I think you have to be highly suspicious of market bounces, that we will continue to move lower. One of the most troubling parts of this market has been the continued persistent weakness in the Russell 2000. The Russell 2000, we've known, has been, it tried to break higher here, and then we last week shook lower below this low, and then what happened? As I mentioned, you don't want to short there because it's more likely to bounce. And it bounced right up to the conjunction of the 200-day moving average and the volume weighted average price from that December low. So this might be putting out the blueprint for what happens in the broader markets. But now, where's the place to be short? It's after, during a day like today, when it breaks down, fails at the 5-day moving average, and continues to get the snot kicked out of it. So the Russell 2000 seems likely to continue lower to me. We could do a quick estimate of where some levels of potential support could be found if we take a look at the Fibonacci. So, a 61.8% takes us all the way down to 149. 50%, maybe we see that next week at about 143.5. The semiconductors had been holding up in here this week, but again, they got crushed too. So now, the semiconductors have been a lot more difficult. They've been a lot more volatile than the broader market, and healthier actually. But they get these big pushes lower. I think they're just in a void. If they don't scare you out on the way down, they're going to wear you out. And it looks to me like we'll see the same thing happen in here. At least a test of the 200-day moving average and the volume-weighted average price from the December low. And just the fact that the volume-weighted average price from the December low is above the 200-day moving average, that tells us there that this market has been an outperformer. Biotechs are doing what a group in a downtrend are supposed to do. I had pointed out to subscribers that, maybe this is the beginning of a transition to a more neutral market, but it wasn't bullish. And lo and behold, we're back down below all of these moving averages, and we're in a bearish environment at this time. It doesn't mean we're in a bear market that's going to last 5 years or whatever your definition is, but the fact is it looks like they're headed for another test of the 100 level. How do you short it? Do you short it after a big move like this, or do you look on Monday for a bounce and then short as it starts to turn lower, and then put your stop in a reasonable place? Your time frame might be different than mine. My time frame is 2 to 5, 8 days at a time. Those are the nice bite-sized chunks that I like to absorb the market action in, and what I talk about each and every day at alphatrends.net for subscribers. Financials also broke below this, or they actually tied this prior low, got a bounce, and then failed this week once again. So they're below a 200-day moving average. They're below the volume-weighted average price from that December low. If we take a look at Fibonacci on here, we can see that we're basically at 38.2%, and maybe this gives us some levels to at least of interest. They're not action points, but maybe these will become interesting levels where this market can slow down and find its stability. There are still unique individual opportunities to trade from a swing trade perspective, but adding new money to this market for a longer term just doesn't seem to make sense to me on the long side right now.